Hi, my name's Duncan Craib. I'm the CEO and Managing Director of Boss Energy and the owner of the Honeymoon uranium mine in South Australia. Honeymoon is a pure play uranium mine with a brownfield restart asset. It previously produced and exported uranium to the global markets before being placed in care and maintenance due to low uranium prices in 2014. Since that time, we've made significant technical enhancements, we've increased our JORC resource, we've taken care of our permitting requirements, and we've formed really close relationships with fuel buyers. So yesterday actually, we released our enhanced feasibility study, which really now positions Honeymoon as one of the next projects to take advantage of this upswing in the global uranium markets.
Welcome aboard. Duncan Craib, how are you, sir?
I'm very well, thanks, Matthew. Thanks very much for having me on the show. It's a real pleasure to be here.
Well, I'm glad to have you aboard. Right, so what people need to know two things. One, I don't even think you know this, I'm a shareholder, so I'm going to try and not be biased, okay? There you go, that's number one. Number two, it's the second time you've actually been on the Crux platform, because I think you joined Brandon and I for, should we call it educational drinks session? I'm going to go with that. we were learning about
fantastic.
No, it was. We were learning about Australian wines and answering uranium questions, which sounds like a dangerous combination, but I think it worked out well. So there you go.
True.
Full disclosure. So look, we're going to talk about Boss Resource today. I'm actually delighted because we have a lot of requests to have you on board, and obviously with the announcement of the numbers yesterday, I'm excited to kind of get into some of that, okay? But first, we should talk about the markets at the moment. Last week was a funny old week, for not just uranium, but across the board.
It was a funny week. I think, uranium equities had a soft time, and largely with a lot of speculation on the Chinese reactor. But within the industry, basically everyone marched on. Those within the sort of nuclear industry, and certainly those operating reactors, didn't blink an eyelid. Standard operating procedure. So, like all these stories, they can get sensationalized, but it did have a softening of the uranium equities.
And we've seen a lot of generalist investors coming in from the tech space, or just outside of uranium, may have been precious metal guys, coming into the uranium equities markets. I think sort of end of last year, beginning of this year. I mean, is that what you're seeing on your register? Is it easy to work that out or not?
It is. I mean, it's an interesting one. So we did a pretty significant capital raise towards the end of March. We raised 60 million Australian dollars, and by and large, it was mainly institutional firms, international. Many of the leading institutions in Australia sort of wet their feet in the stock, which was really pleasing to see. But certainly in the last 6 months, we have seen significant growth in the retail investor, and still seeing that. And often I see a lot of the price fluctuations occurring with that retail. Interesting to see too, Paladin's just announced cleaning up of some of the smaller shareholders on their register. So I think general retail is having an influence on some of the equities.
And with these new conversations that you're having to go in and talk about the macro, because it's an unusual situation. If it was, because it's dependent on price coming back, price on the contracts or spot that people look at. If you were talking about a gold company saying, hey, it's going to be fine because we just need gold to get to $3,500 and then we're off and running. I mean, that's the kind of situation you're in. You having to explain why, in that case, gold will get to $3,500, or in your case, why uranium is going to get to $60.
Yeah, I mean, it's a real question. I mean, a lot of the questions now are sort of, when's Boss going to, I mean, I might be jumping ahead here, but when's Boss going to enter the market? Why aren't existing producers holding up for higher prices? But if you take a deeper dive on pricing, let's refer back to that, I guess we call it that classical financial theory that the whole idea that the existing price reflects all available information. It takes into account demand, it takes into account supply, inventory. It tries to rationalize the market and put a price towards it. And that might work generally for stocks, but it doesn't necessarily work for commodities, particularly energy. So right now we're in this operating cost regime. There are pressures on sellers or primary producers such as ourselves to lower costs and be more efficient with production. But that undersupply can quickly turn into what we call inducement pricing. And it's that where, that strong demand cycle kicks in, and if there's a delayed response, which is what we're going to face in uranium, prices can overshoot. They need to have pricing to induce new mines to be developed. And that incentive price is it's some way away from the existing current pricing. So the industry can't turn around or flip that quickly. And Matt, what a great example. Let's look at copper and iron ore in the past 12 months. They're commodities that have really flipped to that inducement pricing. And it can be sudden, it can be violent, but it's needed to encourage new mine development. So I think there's going to come a point in the not too distant future when we start moving towards that pricing, and we're seeing elements of it. So you're quite right. A lot of the presentations or explanations I give to investors or shareholders is trying to just explain that difference in pricing and where the spot price is, where term contracts are being entered into, and how we actually see the market going forward.
So you said earlier you got access to, and I guess the raise recently to buy physical pounds will have helped. You said you've got access to buyers, and for the utilities and I guess others too. Why didn't they blink an eye last week? Why aren't they out trying to buy pounds? There's a lot of companies like yourself, like Boss. We saw a few people raise money to go and buy physical pounds. We've seen the spot physical uranium trust come along as well. There's a new kind of group of people in town trying to force this price move, it seems.
But they are, and they're taking advantage of the low spot price, similar to what we did. These generalist funds, Anchorage was most recently in the papers, but certainly like the Sprott UPC initiative. But I think, what are we seeing with fuel buyers? I would argue that is there a level of anxiousness kicking in? I think there is. I think there's this unknown. What's happening before us? What are we seeing? I think we're already seeing utilities become more confident, or sort of more interest, I should say, more interest in the spot market, in the mid-term, in the long-term type market. Some firms have already been sort of testing the waters and trying to see what price we'll be happy entering into the market, what preparations are being made. So it's challenging. Where we sit and what we see as a producer is that I think pricing and activity of the fuel buyers is going to pick up in the third quarter and continue into the new year. I think it's not that far away, to be honest.
It's kind of interesting to me, sort of looking back, there's a lot of pounds been removed from the market because of COVID in terms of, shutdowns. And without that, I'm not quite sure, when that kind of natural recovery of the share price, of the spot price or buying price would have been. It's been a very difficult market to read. And I think, COVID's obviously accelerated things, but why is this market so tough to call? Why is it so tough to read? Why can't we be better at understanding the numbers?
It's hard. It's such an opaque market. It really is challenging. While we've got visibility on spot price, it's hard to understand. We're not shown what the market-related contracting is at the moment. We're unable to see that, and it is challenging. And I guess you go back to then being reliant on some of the larger sort of industry groups or organisations that analytically assess the industry. I attended the World Nuclear Association in London back in 2019, and at that stage, very credible organisation was saying that demand outstripped supply, primary production was needed, an incentive price of $60 per pound was required, and by 2020, sort of 2021, 22, utilities would need to be coming out to enter into offtake agreements, and here we are. So it is a difficult, opaque market, and I can appreciate the sort of exasperation sort of investors have, but bear in mind, the reality is that new mines are needed and inventory levels have been decreasing. We believe the US or North America utilities perhaps have the lowest inventory levels of a few years. Europe perhaps a few more than that, and then the Chinese have a a vaster stockpile. But what COVID has effectively done is it's brought that recovery curve forward. And I think, if anything, a lot of the forecasts that have been made, TradeTech, UxC, World Nuclear Association, if anything, those forecasts are now coming, we're edging closer and closer to when that eventual price move will happen. And let's face it, I mean, the spot price has been steadily trickling up over the last few months. I think this morning the average spot was around 32.6 US per pound. And that's before Yellowcake's gone out to buy its inventory, and it's certainly before the Sprott UPC transaction takes place.
It's kind of an interesting space because, like I say, with gold or iron ore or any of the kind of battery elements, you've got more visibility because you know what the metal prices trade at. You got a sense and scale of it, and they're much bigger markets as well. But it seems like uranium has a lot of experts who are not necessarily able to use data to drive it. It's more a feeling or so it's much more emotional response to the market. So Russians bringing back online the world's largest uranium mine. Okay,
that's a very fair statement.
Right. Then you had Taishan, supposed problems there with one of their reactors. Again, not a lot of data, and this data kind of flows through from people who have not even worked in the industry, and they're having an opinion, and they're shaping what is quite a small investment community. And you're sort of seeing these sort of big reactions to each of these quite singular events, which I don't think you'd necessarily see in other commodities. It's kind of a difficult place to operate, isn't it?
It is a difficult place to operate. I mean, partly why we're often we're like that. I mean, we're gauging what's the market doing, and we're gauging that by the level of interest that utilities have. And there has been an increased amount of interest in Honeymoon and Boss in the past 6 months, and it's happening more frequently. So, I mean, it was quite recently. I was phoned out of the blue by a fuel buyer. Requesting on what stage are we at with our feasibility study? When will we be coming into production? I haven't experienced that for a number of years where fuel buyers contacted me. So there are those sorts of soft feelings and using your sort of intel in the marketplace, partly why we enter into requests for proposals or the tendering process. It's to get it. We know that we're pitching higher than existing producers, but we're getting a feel for where we sit in that cycle and how close are we to being awarded a contract. And I actually think that works too for the fuel buyers, because they're also gauging at which price will Honeymoon come on as compared to other near-term producers, and getting a feel for where is that next wave of production coming from, and at which prices will those producers be satisfied with. So yeah, it's a funny one, sort of feeling of a company sort of feeling each other out as to where the pricing points are and price discovery is.
Yeah, and I think and the reaction in the market seems to be we're seeing sort of higher highs and higher lows, and that range seems to be moving the right way. So the sentiment seems to be heading the right way, even with sort of generalists coming in who may not necessarily understand everything, but the message out there is it's moving. Just don't know how quickly, as usual.
Well, I think so. We've been really pleased, for example, by the recent Sprott UPC transaction and what that could entail. And I think that's going to be very positive for the market. I mean, it's bringing more demand into the near term and increasing liquidity on the spot market. I think too that, they're potentially under the ATM arrangement that they have, that they've got the ability to raise significant amounts of capital to buy material on the spot market. And that in itself should help stabilise prices at the moment. We're aware the spot market's already thinning, but it could actually start pressuring the price upwards. So, I mean, again, going back to Honeymoon, my role and how I foresaw it when I first joined the company was to get an asset ready to produce and be really at the start of, put ourselves in the best pole position for the start of the new cycle, ready to seize upon, an increase in the commodity price.
Well, you also tried to jumpstart it. You raised $60 million and bought some physical uranium. I mean, why did you choose to do that?
Oh, there are a number of reasons for that, but primarily the real reason was, how do we put ourselves almost on an equal footing as an existing producer? And what existing producers have is the luxury of being able to feed into physical contracts. So when we enter into contracts, or that initial stage of negotiation, as we've been doing, The question is, okay, how quickly can you commission the mine or restart Honeymoon? What's your ramp-up period? What happens if there's slippage in those few years? How are you going to safeguard our contract and meet the contractual requirements or deliver as promised? And having this physical inventory on hand means that you can, if there is a slippage, you can feed it in to the contract. And that in itself has given utilities a tremendous amount of confidence. And we've had, I think there's about 8 utilities now, 8 or 9, that have actually reached out and said, right, that's it. It's the final bit that we needed to know. I mean, we're not there on pricing, but we're certainly there on the confidence within Honeymoon. So for us, it was really how can use it. I think it works for a company like us, that near start development. How can we best position the company? And all the meanwhile, we're long uranium. So as this spot price is tickling up, that value of the stockpile is going up. So yeah, we feel it was a good move, and it's certainly being endorsed by industry.
Yeah, I mean, I was surprised by the quantum. I mean, that was a big chunk of change that you went for, but you filled it. And I guess the question I wanted to ask you, because we've not spoken about it, is was it partially to allow you to have earlier conversations with utility buyers in terms of, contracting? Because, there's a date at which you can get into production, 12 months from FID, right? That's what you're saying. Low capex stuff, all lovely stuff that I'm sure utilities will want to hear as long as they believe in your ability to actually, deliver, the grade, the consistency, and all of that kind of good stuff. But do these pounds that you bought in the market say, well, actually, let's start the contract on the assumption earlier, on the assumption that we can fill it because we've got a large inventory sitting here, and we'll feed that in as a precursor to our own production. I mean, is that part of it?
Oh, it is part of it. I think the conversations are going on, and they have been going on with utilities for some time, and there are, I'd say, where it's an open book and it's an open market, we'll deal with whomever, but there's some utilities we've been talking to for a longer period of time. They're fuel buyers who we've known for decades and good close working relationships with. So it wasn't necessarily to expedite the conversations with utilities. It was more so giving them the reassurance and the confidence that once we say we're ready to go and we're going to raise the capital for our capex to come to purchase the ion exchange sort of new NIM6 columns and refurbish the existing plant, that at that point of entering into contracts that they've got the confidence that we are going to deliver into them, and therefore the negotiation of terms assists, but it also allows them, if we are in competition with another, let's call it another near-term developer that's yet to build a mine, that doesn't have physical inventory, just helps us be that one step ahead. And that first mover advantage is what we're aiming for, to retain that.
Okay, so I'm just interested in the relationship because I want to get onto you in a minute, which when you bought those pounds in the market, I mean, was that easy? I mean, how many phone calls was that? How many transactions was that?
Yeah, sure. Was it easy? I think we're blessed to Sashi Davies works. I've had the pleasure of working with Sashi for the past decade. She's one of the world's top uranium traders. She's been in the industry for, I think this will probably be the 4th cycle. So very, very experienced, very well known to fuel buyers. And the difference, what we did as compared to others who have been purchasing physical uranium, is we actually, prior to raising the funds, locked those pounds in. So really the pounds were locked in on an agreement subject to the raising of the capital. So we locked in the price, we locked in the quantum, and then we raised the capital. And we had a very tight time frame to do that of 1 week. So it was pleasing to raise that capital within less than 24 hours, really. But was it easy to do? I wouldn't say it was easy. It's certainly easier than it is now in the current market, because that spot market's thinning. But we bought it from two traders or suppliers, so that we limited it to that level.
So did you buy it at spot, or did you have to pay a slight premium for that? Because it's a lot of pounds.
It's a lot of pounds. No, we purchased it at the spot price, the prevailing spot price, which was, I think it was $30.15 US per pound.
So now you play the arbitrage game on that, and whatever you eventually sell it at, right?
Yeah, it's one way to look at it. Yeah. But I think, I mean, we've been in the industry. I think where we stand. I mean, let's face it. I've been involved commissioning a big mine, the Husab mine in Namibia. Wyatt Buck's been involved commissioning mines, and we've got that experience, and Bryn Jones too. And what it's not. Commissioning a mine is a very, very difficult process and a very risky process, and I think that's some of the sort of premium restart projects have in their sort of market capitalisation, is the fact that element of risk building the mine and making sure it works has been largely absolved. So it was really we're looking at it. What's the best way to position ourselves? What's the best way to transition into this new market? What's the best way to have that first mover advantage, and what's the best way to get the best contracts, and that was the decision that was made at a board level.
Okay, well, let's introduce people to you again, because I think there's a lot of generalist people coming into the uranium space and people who may not know your background. So ex-Husab FD, at the time you're looking around and going, right, time to get a new role. You look at Boss at that time in the market, right? That's a difficult time. So you're thinking, right, I can look at a whole bunch of different jobs here, but this is the one for me. Why?
It was a really interesting time. I mean, that was towards the end of 2016 in Namibia. In fact, I can remember having a coffee with Brandon in Swakopmund at the time, Munro, and where do we go to from here? It was an exciting time, and the market was still in the doldrums. So the opportunity came along from Boss Energy, and the board reached out and said, here's an opportunity. You've earned your stripes with Honeymoon. You're in the process of commissioning that mine. Why don't you come back to Australia and take one on for yourself? And we sort of, I took that away, and I did a lot of research on Uranium One, who was the previous sort of operators of the Honeymoon asset, and looked at how they operated, and I thought, well, there is an opportunity here, and that's what grabbed me in my guts, and thought, I've always believed in technical advancements. The opportunity to have a restart project gives you that benefit of looking back and how do we capitalise on their previous operating successes? What can we do that's better? And it's in a stable environment of Australia, so that's what really, really grabbed me. And I mean, it was sort of a few months later, beginning in 2017 in January, I returned back to Australia, and found myself driving up the dusty road to the mine site just outside of Broken Hill in South Australia. So, and since that time, it's been really reassuring to sort of gravitate and attract some of the best industry talent and consult some of the global experts to advance this project, such as where we are today, that we've got an asset ready to be restarted and move into this new cycle.
Okay. So people perhaps not so aware, but may have heard things like Australia is not very pro-uranium or nuclear. So did that affect your thinking?
We're not yet there on nuclear power, and I think that's probably some years away. I feel that we really need both main political parties in Australia to come to that joint agreement that nuclear power is the way to go. Certainly what we are seeing in Australia is a lot more politicians talking about it and supporting that project, and how else do we get to a carbon-free emission type society. I mean, while we can all be renewables, nuclear's got a part to play in that energy mix. But I knew that at the time, but I wasn't so concerned about nuclear power as a source of energy generation in Australia. What I look for is, where's a geopolitically safe operation and country in which to operate from? And when you look at Australia and its 7 states, South Australia is the premier uranium jurisdiction within Australia. The only uranium mines that operate in Australia are in South Australia. You've got Olympic Dam, where uranium's a byproduct. You've then got the Beverley mine, which is 260 kilometres to the west of Honeymoon, that also operates. So we're the third that's about to come into production. So The South Australia is well supported by the political parties in South Australia, and we've got full state support. We've also got full federal government support. In fact, the South Australian government is contributing to some of the geophysical activities, exploration activities in which we're conducting. So, yeah, they support, that state supports uranium mining.
And we're going to talk about the EFS in a moment, okay? Enhanced feasibility study in a second, and you're going to tell us a little bit. But when he tells about what exactly did you walk into with Honeymoon? What was there? I know it's a restart, but what did you look at and go, do you know what, this is going to be okay?
Sure, the geopolitical side, but when I'd assess any project, any uranium project, let's look at the stage of development. How quickly can that project get into production? We know that greenfield exploration type projects can take up to 8 to 10 years until they start producing. So how close is it to take advantage of this next cycle? We look at the permitting aspect, and the benefit of Honeymoon is that it is fully permitted, and by that it's got an export permit for 3.3 million pounds. And to obtain an export permit in Australia means that all your other permits are in good order. Our native title agreements are in place. Does it have a good JORC resource? And we have a great JORC resource, 72 million pounds. And then what stage of the project is it? $170 million worth of sunk capital back in 2012, 2013 to actually build the mine. So we weigh up all those factors, and that's what initially grabbed me. Just knowing that you've got a lot of those foundation aspects in good order. It then was a question for us on, okay, how are we going to increase the production profile? How can you lower your costs to sort of cut your cloth accordingly and be a real contender in this next uranium cycle?
Okay, and so who's the team supporting you around this? Part of that decision-making process. You mentioned Bryn already, but maybe talk about him and who else is on this team that we should be aware of.
Yeah, so take it to Bryn. Fantastic colleague to have. Bryn and I have worked together on Honeymoon. He was first in a consulting capacity back in 2017 when we did our field leach trial, and he helped consult on that basis. And it's been wonderful working with him on the board. He basically had his first 10 years of his career in uranium with the Beverley mine, that mine just 260 kilometres to our west. And Beverley uses in situ recovery, and it uses ion exchange. So he sort of cut his teeth in exactly what we're doing at Honeymoon. From there, he worked with Uranium Equities and some of the top guys in the industry, and more recently he was the COO of Laramide Resources. So Bryn's a fantastic chap to work with, and he's based in Adelaide in South Australia. So really good guy on the team. Wyatt Bucks, the most recent director who's joined the team. Wyatt had his, I think, first 15 years with Cameco. He ended up being the general manager for McArthur River, Cameco's primary asset. And was then headhunted by Paladin to see its Langer Heinrich mine, its flagship mine, from commissioning to nameplate production, where he moved to Namibia for 5 years. And after that, sort of relocated back to the Perth headquarters, where he oversaw the Langer Heinrich and Kalakira operation for a few years. Post Fukushima and the dive in prices, he then joined First Quantum as their director of operations and project execution. So Wyatt's very stable hands, been there, done that, just another great guy to work with. We have Peter O'Connor as the chair. Peter was the senior non-exec of Northern Star, which is Australia's primary gold producer. He was involved with the company from a 300 million market capitalisation to when he stepped off quite recently at 10 billion, and very, very experienced with global markets. So Dudley Kingsnorth, experienced metallurgist, and Sashi, who I've mentioned. So really a strong executive team. On the operating side, we've started developing our own owners team, and it's the team to take you forward. Trevor Robinson, very skilled engineer. I actually met Trevor in when I was on HUSAB. He was installing some of the columns there. very skilled with ion exchange. So terrific chap to work with, and he was a key component of this study that we've just undertaken. Merrill Ford, very skilled again with NIM6 columns, and he's been in the industry for his whole career. And Trevor. So we've got a very strong team, and we're now looking to develop that further. But it has been tough. It hasn't been easy. I mean, we haven't, as you're well aware, I mean, the industry's been in the doldrums, and we haven't really had sort of the market interest until the last 12 to 6 months, where we've been able to now, let's think about operational readiness. Let's think about headcount. Let's think about getting the right people in place. And fortunately, again, South Australia, with its operating uranium mines, it can attract the right talent. There's experienced people there.
It's very interesting dilemma that CEOs have when markets are quiet, because there's not a lot of money around, not a lot of interest, not a lot of volatility or trading or momentum, just generally in any aspect of it. And you've got to just quietly go about your business. It's kind of like minimal viable product people use in some other applications. But for you guys, you just had to sort of do these baby steps and quietly move things. So you haven't been, not necessarily having the money to attract the right people, not necessarily having the money to do the things you want to do, because there's no need to have an end product, because there's no market for it at an economically viable rate. So that must have been tricky, 2016 through to, let's say, 6 months ago. Difficult.
It has been. It hasn't been easy. And, I take my hat off to colleagues who have also stuck it out. It has been tough. The flip side of that, of course, is projects such as ourselves. We've had the time to really, it's almost like campaign style of getting a mine back into production. What element do we need to look at? Is it the resource that we need to expand? Are there areas of the project, of the processing plant that we need to look at? And you can sort of dissect it, pull it apart, and put it back together again. So over the course of the journey, those campaigns, we've tried to dovetail with the market, and it's really pleasing to now see that come off. But it's been challenging. So really reassuring to finally feel like we're moving in strides now. But we've still got some way to go. But it's generally very positive what we're seeing in the marketplace. And
that was my very weak attempt to lead into EFS, because I've not heard the phrase very often. Enhanced feasibility study, not a feasibility study. This one's enhanced. It's like debt, why enhanced? What have you been doing? Supercharging it.
Matt, maybe, I don't know. I just thought it suited what we were up to. I mean, there's no defined reasoning for that other than it seemed apt to use. We released a feasibility study in January of last year, and towards the end of that study recognised that we should go purely ion exchange and do away with the existing solvent extraction process. So up until that point, we're going to do stage 1, refurbish the existing solvent extraction process. Stage 2, bring on ion exchange. With this study, we've gone completely ion exchange, and that was really predicated for 2 reasons. Firstly, increase the production profile, and secondly, decrease costs. But enhanced seemed the right word at the time.
Great marketing. Your marketing team worked overtime on that one. So, but serious question now though is we've seen companies like Peninsula struggle technically, certainly in terms of what they've been able to say to the market, in terms of their enhancing or optimizing their technical solution to extract at better rates. So, and I think that'll all be fine in the end. But it's added another sort of 6 months to their process. When you made that switch, were you trying to solve problems with the other solution, and you couldn't, or was it genuinely we think we're going to be able to get better economics going this route? I mean, why the switcheroo?
Why? Well, I mean, Wayne Healy at Peninsula, I mean, he's technically very, very savvy. I rate Wayne highly, and I'm sure he will get on top of that leaching chemistry. But for us, one of the main issues, or the crux of Uranium One's issues, was the low tenor of uranium being leached or into the pregnant leach solution. So they averaged only 53 milligrams per litre. So suboptimal tenors such as that have a detrimental flow-on effect to increasing operating costs. So we had to address that problem, and we did that through a few reasons. And this is where Bryn came in, and we had Dr. Dennis Stover, leading ISR expert out of North America, really brought in global experts. But we had to look at the wellfield performance. What could we optimize there? And we looked at new techniques in Kazakhstan, the design, the construction of those, and understanding the geological interpretation of those well fields. So I thought that was one area that needed to be addressed, that probably could have had more time spent on it previously. But then we looked to how does the Beverley mine operate? I mean, it's been producing for years now. It's very profitable. It's producing up to 4 million pounds per annum in, again, very close proximity to us on a similar ore body. Very good widths, etc., but very similar. So we looked at what do they use in their leaching chemistry, and that was lowering the pH levels further to what was, and then increasing the iron tenors in the leach chemistry. So having tested that in MET testing in the laboratory with ANSTO, Australian Nuclear Science Technology Organisation, we then did a field leach trial for 6 months in 2017, and it worked really, really well. It was a major breakthrough for the Honeymoon mine, that's really what when I knew that we had something really worthwhile, and it was at that point that we started attracting some big institutional interest who had dedicated uranium sort of funding. It started coming in around that time, and it's been really worthwhile.
Well, it's really interesting to me because it comes back to the conversation about the lean times. When the market is dead, when money is tight, you don't have the cash to be able to do these experiments, to be able to look at alternatives, or just sense check your own thinking. And it's kind of there's quite a few instances where the solution, the end solution, comes late in the story because the money is available. So that's why I'm interested about the difficulties of the lean periods, and then this kind of sort of inflection point where you are able to do the things that you know that you're going to have to do because the money's there.
It is interesting. It's an interesting dynamic. I mean, just looking in other type of mining industries. I mean, iron ore, for example. I mean, some of the major technical breakthroughs happened during the lean times, where you have to be careful with your cash and you have to look at innovative ways to move forward. In this particular example, we knew we had to get the wellfield right. We knew we had to get the leaching chemistry right. And by the way, even though Uranium One, we're averaging 53 milligram per litre, and that field leach trial that we did averaged 80 to 90 milligram per litre. For our study, we're only using 47 milligram per litre. So we've been very conservative to take into account what could happen. But yeah, it's fascinating. And I think that, put your heads together and use, there have been industry experts throughout the lean times, and draw upon their expertise, and we work together and achieve the outcome. And it's it's been really pleasing and fortuitous. I mean, the other aspect to that field leach trial, of course, was testing new resins that could cope in that high chloride environment in which we operate. That also has been a standout success. I mean, the recoverability of the resin and ion exchange was 95%, irrespective of the grade of uranium that we were leaching. So yeah, technical advancements happened, but while we were in the doldrums, we also had that luxury, I guess, of time. But while time, you also have to show results. You have to keep the story moving. What milestones are you saying to the market that you're going to achieve? Are you achieving them? How are your results? And there's a lot of arm waving in any industry, but I'm very proud of what we've achieved, and it's been pulled apart. We've had, this is the second feasibility study we've done in 18 months. I don't know what more we could really throw at this, and we've been completely transparent in that whole process. So very, very pleasing outcome.
So talk to us about some of the numbers that have come out of this enhanced feasibility study, because I know people can read, but let's just mention some of the key numbers now, because I'm interested in the FID. That's what
Sure,
what I
okay.
want to talk about. So just give us the highlight numbers on the EFS.
I will. I mean, we've received a lot of good positive publicity since launching the study yesterday. And in an interview of a few weeks ago, Rick Rule said, Boss was his favoured or the least overpriced of the juniors. And since that time, we've been able to come out with this study. But what we've shown is that your MPV, we've assumed a US 60 US per pound base case study price over the life of mine. We've used an exchange rate of 75 Australian cents to a US dollar. What we've seen is that we can achieve an MPV pre-tax of 309 US million. That's up 35% since the last study. We've got an IRR of 47%. We've got a sort of an EBITDA margin of 62%. So that's been based on the fact that we've been able to increase that production profile from 2 million to 2.45 million pounds, and at the same time decrease the operating costs. So all-in costs have reduced 11% to 32 US per pound. The all-in sustaining costs are down 16% to around 25.6 US per pound. And best of all, cash costs, we've got sub 20. I mean, they're now at around 18.5 US per pound. So that's been a really positive outcome. It has resulted in slightly higher capex. We'd gone into the study, as mentioned, having the existing solvent extraction process being part of our production profile, but we've now done away with that. So by doing away with that, we've added a few more ion exchange columns, and now the overall capex requirement is 80 million US.
Right. So those numbers look great. I think we're also let's just talk about expansion, exploration, expansion potential here too, because I think the market's assuming that you are going to be able to add to the pounds here. Now you're licensed for, I think it was so what are you licensed for in terms of production? We're licensed for up to 3.3 million pounds. Right. What's the likelihood of being able to get extensions in Australia to that once you're up and producing?
Oh, there is. I mean, at the time we renewed the export permit, which is nearly 18 months ago, I think, 18 to 24 months ago. Had a good talk with the minister, and he absolutely we can expand it, but we need to prove that we've got the resource. We need to prove that we can actually increase that production profile. So that's the next step. So really, what we're up to is really maintaining an exploration focus and advancing those sort of near mine and exploration targets. At the moment, the feasibility study is predicated on 36 million pounds because that's what the mining license sits on top of in what we call the honeymoon restart area. But outside of that mining license, there's another 36 million pounds in two, we call it satellite domains. One's called Jason's, one's called Gould's Dam. We'll look to firm those up or bring the level of confidence into more measured, indicated categories of the resource. But also we've got an exploration target of up to 190 million pounds. So that we're looking to really exploit. And at the moment, the geological team are actually in the field. They've been in the field for a few months now, finishing the passive seismic surveying. We're then going to do active seismic or high reflective. We're really trying to gauge as best we can the picture under the surface as to where the resource lies, and then go in with the drill rigs to start drilling. And we're planning to do that in the fourth quarter of this year. So our focus now is very much on a project perspective, growing the resource and increasing the mine life and increasing our production capacity. But I think, Matt, before just moving on, I think while we've talked about numbers and the feasibility study, overriding all of that in my mind was how do we de-risk the operational side of things? How do you make this more operationally viable and take away that operational risk? And that was moving purely to ion exchange. And I mean, that to me was the overriding reason for doing this. What we've had the benefits, we've decreased costs, we've increased production profile, but we've removed a lot of the operating risks. I mean, when we get up and running, you want to make life as easy as you can for yourself, and this was deemed to be the best way. So we've been able to prove that.
No, I understand. I agree with that. I mean, the numbers are super, but you needed to technically de-risk this thing, or at least use the technology solution to actually enhance the economics. So I think you've done that. Certainly, when we were looking at you, that's what we were encouraged by. Just in terms of the allocation of resources, right? You've got a decent sized project now. You've shown that you can go and easily raise money to buy pounds because that people just viewed that as an arbitrage play, right? I know you say there's more to it than that, but I think the market looking in and go, well, that's just an arbitrage play. That is smart. I'll invest in that. Your capex is quite small compared to many. So it's not. I don't imagine that's going to be an onerous task to go and raise the capex there. Do you go and raise a little bit more to accelerate the exploration component, the increasing the resource component?
Yeah, good question. I mean, we do have, I mean, at the moment, we've got 20 million Australian dollars in net cash, and that excludes our 100% backed, environmentally backed bond with the state government. But that is enough to continue on with our exploration profile for the moment. So no, we don't need more monetary resources really to push that forward. We've got a good plan, and certainly we've got enough cash for the foreseeable future. But it's really how aggressive do you want to be at drilling, and that's one that we need to sort of, I guess, dovetail a bit with the market. I found that let's say since we acquired the project, we've grown that JORC resource from 17 million pounds to 72 million pounds. So we know the resource is out there. But drilling is not a cheap exercise. So hence the geophysical work that we've done, and now we take the rigs in. But in the past, when I've put out mineral resource statement upgrades, we've announced drill results, and it excites the market, and you get this instant gratification of great, they've achieved, but then it dives back down again. So it's a tough one. I think we've got to be sort of mindful and realise that we are we're a restart project. We're very close to getting into production. There's clearly an exploration upside and that we want to capitalise on. Let's do it in sort of dovetailing with the market increasing in its commodity price.
Okay, so it sounds like you're happy with your lot here. We've had a bunch of questions sent in. Do you think there's going to be a lot of M&A in the junior space? Yeah. Are you interested in that? Have people approached you? Just generally, what's your mood about what's happening out there, re-M&A?
Yeah, we're very interested. I mean, first I wanted to get my sort of ducks in a row and make sure that we've got an asset that, as Honeymoon, that we've de-risked and ready to go. So that was our priority as a company. But no, certainly we've been dedicating, Bryn and I, perhaps 5 to 10% of our time looking at other projects. We've taken a deep dive on a few. A few look really interesting, but they're I don't know. I guess the commodities have run. The equity prices have run. The valuations have got a bit skewed in our view. So we've had to sort of take a breath and think, okay, is that value for money? Is it value accretive for shareholders if we do this? But through that process, what it has allowed us to do is develop a discipline. What projects are we looking to do M&A with? We'll look more towards an advanced project. We'll look more towards a sort of tier 1 jurisdiction. But certainly we're very much open to the idea of M&A. Have other groups approached us? Yes, they have. Really sort of friendly conversations, just sort of testing the market, seeing what each other's doing. And how open-minded we are. I think we're undervalued. So the timing's not right for us. But yeah, like all things, I mean, ultimately it's a public company, and we need to do what's best for our shareholders. There's no ego in the room. I mean, ultimately, you have to deliver for shareholders. So that's the primary objective.
Okay, some companies' valuations are a bit skewed. Your words, XFD, you've done a bit of M&A in your time, I suspect. Give some investing tips here. What are the three things that you look at in a company when you go, I need to work out if that's priced fairly? What should we be looking at?
What you should be looking at, I mean, it's difficult not being able to do in-depth due diligence. I mean, you really need to be able to have that ability to look behind the scenes and understand what are the cost drivers behind those numbers. What can you do to make the operation more efficient? So I think really it's confidence over the resource. What grade is the resource? How large is the resource? And what mining technique would be applied to really to do that? We look at the permitting aspect. We look at the jurisdiction. Is it supportive of the actual uranium mining? How supportive will it be going forward? And what hurdles could you face? They're probably it's very simply put, but mining, processing, and the actual the jurisdiction that they're operating in.
Okay, yeah, it's interesting. I think some are undervalued, a lot are overvalued. It's a toughie.
It's hard. I mean, I was advised at the time, and we did our best. We looked at projects when before the sort of spot price or commodity price started to move, because at that point the market had been in the doldrums for a long period of time, and you're going back to that classical financial sort of theory. You would have thought that it's a bit of an equal playing field, and analysts and shareholders had taken those factors into account. So it was equal playing field. We could assess each other at that equal price. But let's face it, I mean, the past 6 months, some projects companies have been very effective at marketing, and some haven't. And we'll all get there in the end, but I think the valuations are moving around a bit. So it's a bit more challenging and needs to be taken into account. But our way forward, we really need to look at M&A, and at the same time, we need to look at increasing our actual resource base.
Okay, Duncan, and just let's come back to this FID. Okay, now you've got your EFS. You are closer to putting yourself in a position where you can actually start putting some meaningful numbers together around the capex. So you're going to be having conversations with groups about financing that. So what's the timeline look like? I mean, I guess it's going to be market dependent in terms of price recovery, etc. But how quickly can you move?
We can move quickly. I mean, within 12 months we can be producing, but yeah, it's an interesting one, and Sashi and I are working very closely together and looking at what is the right price to come into the market, and when will that be? What we want to do is create a profitable and sustainable mine, and our strategy largely will be influenced by discussions with lenders in terms of an ongoing and clear understanding of what price is needed to get the best terms for raising the capital requirement. Contract sizes can vary. At a minimum, they can be £100,000 a year and upwards, but we intend to keep our focus on really building a sort of a sustainable mine that protects you against the downside, market-related contracts that can also give you exposure to the upside as the price begins to move. And as mentioned, layer in our sort of contracts into that rising market. So once we see spot price moving and staying above, the mid-high 30s, we'll be taking it very seriously. And the contracts that would be looking to enter into, by layering, you've got different pricing mechanisms, you've got different volumes, you've got different durations. So you sort of move with the market. But that to me is a bit of a science into itself, and really fortunate to be working with Sashi in that regard and taking that deep dive. We've been spending a lot of time on that, and the flip side of that, of course, is trying to gauge when will utilities start entering the term market, and what are existing producers going to do. And it's actually quite complex, but again, it goes back to having the mine ready to go, and we're good to go. It just takes away that element. So it's quite exciting now to be dealing with another facet of the project, and and taking it forward.
So, but just so I understand, I understand what happens from the moment you do, the FID is made, but prior to that, you're showing. I'm sensing some degree of confidence about being able to go to the market and raise the capital. You know where you're going to go. You know who's going to come in, and I guess what you don't know is what the cost of that's going to be. So, can you talk to us about the pre-FID component?
So what I found, Huseb's a good example. What I found there was we had a time frame. We wanted to get the mine into production, commission the mine, get it into production within a set time frame. Call it 3 years, and in actual fact, it took 4 years. But what happened during that process is you have your owners team and you start building out your executive team more on the operational side. As the finance chap, my role was setting in, the finance, the accounting policies, procedures, systems, etc. But it was also looking at raising the debt component. And we as part of the team, we secured a syndicated agreement of 1.642 billion US, and then a further 400 million from one of the local Southern African banks. But that took time, and it's dedicated due diligence. And so meanwhile, the owners team were kicking on with their project assessment and getting their various sort of teams and blueprints in order, ready for the finance to come in and allow them the opportunity to spend the money and build the mine. But there was a delay, and that delay is expensive because that owners team are not being fully utilised. So the approach taken this time round was, okay, we know we're not there yet. We haven't signed offtake agreements, but let's start that process now. So we've appointed a independent debt financier, a debt advisor, to work alongside with. And their role has been testing the market and seeing what financiers are out there that are willing to invest in uranium production, that are willing to invest in a project like Honeymoon. And we've found about a dozen worldwide that are very keen, that have had a good look at us. And the next stage of that sort of due diligence process that they undertake is to then have a proper assessment of our financial model, which we'll be sharing with them, of the financial model that is of the enhanced feasibility study, that we'll now share with them to allow them to continue on with their due diligence. So the whole purpose is such that when we land our initial offtake agreements, the preferred financiers are already advanced with their due diligence, such that you've shortened that time frame with which they can sort of start lending you funds to get going. So that's the sort of basis that we've taken this time round.
Okay, so can you put a time on it? I mean, well, first of all, let me say, owner's team is not another phrase I haven't heard before. So you described who's in it, but is that a normal thing in Australia?
I think globally, well, I don't know. I mean, that's what I was used to, certainly in Africa. Owner's team is really it's probably, okay, to put it into context, owner's team is a term used when sort of commissioning a mine. Many companies such as ourselves are not experts at employing the engineers to build the mine. So you do what's called an EPCM type contract, where you assign, say, for example, our study manager in the studies was GR Engineering. They come in and they do the independent assistance of building the actual mine. What we do as the owners team is we're the operators. We're there to say, guys, did you build that part of the plant, the precip circuit, the drying room? Is it up to standard? Is it working towards the metrics of what we need to actually have optimal production? So, owners team, operators team, I guess, is probably a better way of putting it. Sorry.
No, it's just I like this. You want to get the vocabulary right. So
you'll hear more of it as these mines come into production.
I suspect. So okay, so that's the owners team. I didn't get a sort of time frame there. I got the process, but again, you're going to sit back and sort of wait for the market. I agree. I suspect to a large degree, but have you got an idea in your head of what you're aiming at? What are you seeing in the marketplace?
Matt, it is difficult. I actually think prices will start picking up at the sort of third quarter of this year going into next year. That's when, and I'm talking about moving to the mid high 30s. That's sort of what we have in mind. But It is difficult. But what we know, and what I tried to explain earlier, is that when the prices move, and you move that sort of pricing from, to that inflection point, it can happen really suddenly and violently. And if going back to when I was involved back in 2007, 8, I mean, the spot price was running at sort of dollars a week. I mean, it really started moving quickly. And so when it happens quickly, and you need to be prepared. So we're doing the best we can to be prepared, but actually gauging the point that will happen is difficult. And I mean, I sort of think, why isn't the price moving now? I mean, we've looked at it from a fuel buyer perspective in this conversation. We've looked at it from my perspective, but why aren't existing producers holding out for those higher prices? Why are they locking in prices at this level? And I mean, our understanding is that there is a level of producer discipline at the moment, but it's only the term indicator that's actually reflecting sort of fixed and base priced contracts. We're not actually seeing the market-related pricing mechanism. So it's difficult sitting outside what the machinations that's going on of the existing producers and what they're seeking to achieve. But what we're hearing is that producers are offering more market-related pricing mechanisms and hybrids that include sort of market components. And while that doesn't impact the sort of term indicator, it's a positive, as it's sort of allowing future deliveries to capture the upside of market movements. And it's also reflecting producer optimism about the future. They're not fixing contracts, they're going market related. And that's been a really sort of positive development within the industry. I wish I knew, basically, when that time will be. I think it's coming soon, and I'm reassured that we're ready, and I'm reassured that we're now focused a bit more on operational readiness and taking that next step. And I've been waiting for this period for a long time. So yeah.
Brilliant. And just one final question, just on the OTC, are you seeing a lot more trading there? Are you seeing a lot more interest from generalists in the US, North America?
Well, we're there by default. I think we're there as a pink slip. I think we're the lowest categories. We're now making...
No, there's grey. There's also grey.
There's grey. Well, we're moving. Well, you'll be pleased to know I've engaged now, and we are moving. We've actually had overwhelming... we've been pressured, actually, to now lift it, and so we're doing it. And I think on average, I think the average volume now we're trading is around 1.4 million shares per year. Per day, daily. It's controlled by market makers, so it's sort of, you're probably quite familiar with that type of process. In the UK, we don't really have it in Australia. But yeah, I am seeing more interest in generalist funds. I hope it continues, and I'm sure it will. I think that the exposure, for example, the UPC Sprott transaction on the New York Stock Exchange will also help do that. But yeah, the market's looking positive, and we're receiving a lot more sort of calls far and wide from new brokers to the scene. And again, it's sort of retelling or helping them understand the framework and understanding the sort of pricing and what they can expect to see. But it has been challenging. It's an opaque market, and it's really the specialist funds some of them have really saw the opportunity a few years ago, and they've done very well today. I mean, they've had some good gains, particularly of the last 6 months.
Yeah, I mean, you've got a few nice ones in there. You've got Paradise, Sachem Cove, and Tribeca, firmly ensconced in you, and I think they continue to buy as well at opportune moments. So, yeah, look, Duncan, I've taken up enough of your time today. Appreciate it. Thanks for coming on. We've been trying to make this happen for a while, and I'm glad we got there. I know a lot of people are excited about your story. We are too. Operationally ready, like a Boy Scout, aren't you? Be prepared.
Matthew, thank you, and thanks so much for your patience having me on the show. And I'm really grateful for the opportunity. And yeah, thank you.